The market correction we're seeing right now has naturally led to a decline in the value of some of our favorite ETFs. As of this video, the Vanguard S&P 500 ETF is down 11% in the past month. The Vanguard FTSE Global All Cap Index Fund has fallen over 6%. The iShares MSCI World ETF is down nearly 9%, and the list goes on. Of course, this isn't too surprising, since US stocks dominate these global indices, making up over 70% of the MSCI World Index and more than 60% of the FTSE All World Index. At the same time, the US dollar has weakened against the pound, adding even more pressure on returns for British investors. Since a weaker dollar means our US stocks holdings are worth less when converted back to pounds, this currency movement has only made the decline feel worse. So what should we do? Is this time really different? Should we consider getting out of the market? And as British investors, does currency hedging actually make sense? Let's dive in. If you've started investing in recent years, it probably feels like the market only ever goes up. So this current correction might come as a bit of a shock. It might even feel like this time is different, and you could be tempted to sell everything. But let's take a step back and put the situation into perspective, so you don't end up making decisions you might regret later, driven purely by the emotions you're feeling right now. Here are the monthly returns for the FTSE All World ETF. The last time we saw a correction like this was in 2022, which started with 2 consecutive months of losses. We also saw a significant drop in 2020, with the ETF seeing a significant decline in the first 3 months of the year. Now, if we look at the S&P 500, it historically had a 5% pullback about 3 times a year, a 10% correction once every 16 months, and drops of 20% or more roughly every 7 years on average. So the key point here is that the correction we're seeing right now is nothing unusual. It's happened before. What feels different this time is that things like rising debt and the pressure to refinance could be affecting the market in ways we haven't really seen before. The US government needs to refinance $9.2 trillion of debt this year, with 70% of it due in the first half. If a recession happens, or even if people just start worrying about one, it could lead to lower interest rates on US bonds, making it cheaper to refinance. These worries have already caused the stock market to drop, as investors are concerned about slower economic growth and how it could impact company profits. Also, the US is spending around 5% of its GDP just on interest payments, which makes lowering borrowing costs a big priority. So all these factors could be affecting the market and influencing how investors are feeling right now. Another thing to think about is the US dollar. Over the past month, the pound has gone up by around 2.7% against the dollar. As we mentioned earlier, for British investors holding US stocks, a weaker dollar means the returns will be worth less when converted back into pounds. Now, in light of this, you might be thinking about switching to pound-hedged ETFs instead of the usual unhedged ones. But here's the thing, when you compare the performance of world ETFs, you'll quickly see that hedging doesn't really pay off in most cases, especially if you're in it for the long haul. For example, take the iShares MSCI World ETF. The pound hedged version on the left has an expense ratio of 0.55%, while the unhedged version on the right has a lower expense ratio of 0.20% per year. The cost difference alone makes the unhedged version seem more appealing. But what about returns? Well, over the long term, the unhedged version has delivered much higher returns than the hedged one. In the past 15 years, the unhedged ETF has returned over 390%, while the hedged one has only returned 320%. Even if we look at the returns in US dollars to ignore the exchange rate difference, the hedged version still lags behind by 60%. So unless you're completely sure that the pound will outperform the US dollar by a significant amount during your entire investment period, sticking with a hedged ETF is probably not the best idea for long-term returns. Now, the big question is, will things get worse from here? The short answer is we don't really know. There are concerns that stocks could keep falling, especially with the tariffs President Trump has imposed, which might spark a global trade war. But whether weaker growth will lead to a big drop in corporate profits and send stocks into bear market territory with a 20% drop from their peak is still uncertain. Remember, corrections happen more often than full-blown bear markets, and they can actually be healthy for the market, leading to more stable and dependable gains over time. Just look at the post-COVID-19 market correction. After the pullback in 2022, the S&P 500 rose more than 20% in both 2023 and 2024. Sure, corrections can feel painful in the moment, but they don't tend to last. On average, the market loses about 13% during a correction. But historically, that loss has been recovered in about 4 months. In the bigger picture, a correction might just be a small blip on the radar for long-term investors. Looking back at the previous 15 corrections since 2008, the S&P 500 has been up more than 15% on average in the 12 months that followed. Of course, there is always a chance that this correction could turn into a full-blown bear market if the market drops more than 20% from its highest point. However, the odds are it won't. In fact, historically, 60% of times the S&P 500 has dropped at least 10% since 1928, it didn't end up falling as much as 20%. Now, you might be wondering how long it would take for the market to bounce back if this correction were to end soon. Based on history, the S&P 500 usually recovers in about 4 months from a drop like this and reaches new highs again. But what if this correction does turn into a bear market? On average, a bear market lasts about 9 months. And the S&P 500 drops by around 33%. So if we are in a bear market, the decline could continue until November, with the market falling another 25% from where it is now. Of course, this is all just speculation, based on how things have played out in the past, and may not really reflect what actually happens. But with all this uncertainty, what should long-term investors actually do right now? Well, the first point I want to make is that you haven't actually lost any money. Remember that your investments have just gone down in value, but until you sell them, you haven't realized the loss. Many people argue that they're losing money right now, but that's simply not true if you don't sell. So keep that in mind. Next, if you're investing for the long term and you don't need access to your money in the next few years, the best course of action based on historical data is to do nothing, or better yet, keep investing according to your strategy. Whenever the market corrects, you will always hear people saying this time is different. Just like in the past, there will always be a new reason to worry and consider selling. But remember, this is what investing is all about. It's a cycle of ups and downs, and this kind of volatility is the price we pay for long-term investment gains. I don't want to be the person who keeps pointing this out every time the market corrects, but you've got to remember, market declines are actually very common. The truth is, the stock market is supposed to dip every once in a while. It can't just keep going up forever. And actually, if we zoom out a bit, you'll see that the S&P 500 is still up more than 100% over the past 5 years. It's a good reminder to always keep the bigger picture in mind. The point is, we don't need to do anything fancy here. We simply accept that we don't have all the answers and keep adding to our investments month after month, patiently waiting for the market to recover. Think of this as a chance to buy more shares of strong, profitable companies at a discounted price. In fact, to really show the power of doing nothing, let's take a look at this chart. It demonstrates that the longer you stay invested, the less likely you are to experience negative returns when investing in a stock index fund. As you can see, once you hit the 10-year mark and move into the 15 to 20-year range, there isn't a single period where you would have made a loss in the stock market. Even in the worst 20-year period shown here, you still would have made an average of 6.4% per year. And during the best 20-year period, you could have earned as much as 18% per year on average. So even though your gut might be telling you to sell when the market is down, staying invested is likely the best choice in the long run. For me, all that's happening right now means very little, and I won't be changing my investment strategy one bit. As a long-term investor who sticks to low-cost investing, I'll keep investing month after month in my global ETF, just as I always have. In fact, speaking of global ETFs, are we making a big mistake and paying unnecessary fees by investing in them? Well, check out this video next to find out.